Maverick Traders, this is Rob Reinhold. I'm joined by Darren Fisher, and this is the Trading Room. We just wrapped up our very first monthly options expiration cycle in January, so good job this year, traders. We're already seeing some good profits here this first month, but as we always say, that was last month. We have to take a look forward to the month ahead. So let's jump into what happened last week. We talked about how the market was at a real inflection point last week and how it had run all the way up to that upper trend line that it held in March and in July and again in October. We were right back out of that, and we said we think it's going to take a little bit of time to get through it if it does get through it. We had gone a long way and we needed to rest for a little bit. So sure enough, this week we tried to break out on Tuesday and it failed. Tried to break out on Wednesday and it failed badly. And on Thursday, it actually looked like, we may not even stay up around this area. And then on Friday, the buyers came back with a vengeance and closed it at its highs. So we are seeing these kind of push and pull in the market, and we are in a no man's land. And we're going to take a look at the charts. We're between a bunch of moving averages, and right now there's really no clear direction. There are very strong inflows into overseas markets. I actually read a report that said that there have been more inflows into the Chinese stock market over the last 3 weeks than there was in the entire 2022. If you go out and you take a look at all other countries and look at their charts have already broken out of the ranges that the US market just hasn't yet. We're seeing this large overseas rally, and for the first time in a long time, the US markets are lagging it. That being said, if those markets continue to rally, they're going to pull the US market along with it. As far as economic news goes, we did get the PPI last week. The PPI came out weaker than expected. The core number was as expected, 0.1, but you can see the PPI supposed to be down negative 0.1. It was down negative 0.5. We also got a weak retail sales number, and take a look at this Empire Manufacturing Index number. Negative 32.9. That is a nasty, nasty number. This week, the Fed got news that it could use to basically say, hey, maybe we don't need to be as aggressive. The one spot that might worry the Fed is the unemployment claims dropping down to 190,000. That is still showing that the labor market is extremely tight. So here we have leading indicators like the manufacturing index, just horrible. That's a horrible number, negative 32.9. But then we have these lagging numbers like employment claims still looking high. I think the Fed is in a bind here. They want to be very thorough and make sure they fight inflation. But I also think there is some data that's showing them that maybe they have done enough. What do you think, Darren?
Yeah, I mean, that's going to be a tough call for them. You're right. I mean, the leading indicators are looking bad, but you got the producer price index coming down. I think people are going to be looking at the CPI though. I think they've got to look at the CPI. I mean, this is going to help. I mean, because remember, for the longest time, it looked like the PPI was moving up faster than the CPI was, and that was squeezing margins in the companies. They just couldn't pass on their cost increases to the consumer fast enough without getting any backlash. I mean, it's good to see that the PPI is going in the right direction, but I think they're still going to try to raise prices to capture what they could not capture in 2022 as far as profitability goes. I think we're going to have. I still think we're going to see the 10-year above 5, approaching 6 before June. I think that's what it's going to look like. I don't think the Fed has any choice not to do that. You could really get into a situation where the leading indicators look bad, but inflation is still running rampant. And I think they've got to get a handle on inflation. I think that's their primary concern.
I agree. And these next couple months, I think, are going to be very key to see the data come in. And if the employment stuff doesn't start to roll over, I agree, they have to keep raising. But if they see employment start to roll over, then I think that is the green light for them to back off. But we'll see. And that's what this market is all about right now. It is about the Fed. It is about future interest rates and whether or not that they can engineer a soft landing, which means they slow down inflation without killing the economy. That's very tough to do, and every central bank has tried to do it, and very few of them have succeeded at it. So let's take a look at the market performance last week. As you can see, the Dow took it on the chin, down 2.7%. Now that, as a headline, we'd be like, oh, that's a bad week. Not really. Take a look at the S&P, down 0.6%. The Q's up 0.6%. The Russell down 1%. This was basically a flat week when everything was said and done. Oil was up. Gold was up slightly. Gold was making a nice run to some all-time highs, getting close to it. Let's take a look at the charts because the charts are all we care about. And here we are. Our long-term trend line comes right around here. And you can see we hit off it here, here, back here, and we just hit off it right there. Here's the thing though, we didn't turn and fall down. We actually made a lower high. We actually made a higher high. So we broke out of this little range here. We ran all the way up here. We said, hey, it's probably a little out of gas. We need to back off. And we either was going to base or pull back. Here we got to pull back. This is a very strong candle. Going into next week, we close at the high, meaning there were still more buyers than sellers. Unless something happens over the weekend that scares people away, Monday morning is likely to have more buyers than sellers as well. We go over here to the NASDAQ. Same thing. We've got our trend line has come down. We're just right at it. We're right at these levels. We're basically exactly where we were last week. But this time, we've had some consolidation. We've had 4 days of some chop before we now can possibly gather some energy to break through to these highs. And if we go to the VIX is showing us, yes, we had a little pop on the VIX, but then quickly turned over. I think this VIX is likely to stay in the 20s, 18 at the low, 22, 24 at the highs, unless we get some major news out there. Overall, I think you got to take a look at this market and take a look and see that this market has made a few runs at this resistance line, and every time in the past, it's hit its head hard and just absolutely got obliterated. This time it hit its head, it backed off, and then it's taking another run at it. We don't know for sure what's going to happen, but we know that the more times that something tests resistance, the more likely it is to break through it. I've looked at a lot of other overseas markets and even stuff like the Russell 2000. They've already broken through that. I just think that the markets move together, and I think it's going to be pulled up through that resistance line. That being said, I am not saying this is the start of a new bull market. The backdrop is not conducive to a massive bull market. So I think we get a break up, but I don't think there's a lot of juice to it. What do you think about that, Darren?
Yeah, I'm more bearish than you are, honestly. I think that we're going to be choppy, and I think we've established the range for the next couple of months. And that's the only thing. I mean, I'm trying to remove, and you make a very good point that the overseas markets could try to drag the U.S. markets up. But if they were to do that, it's going to be kicking and screaming. That's where I'm at right now. I think we just chop and go sideways. It's like you said, the background is not there for a bull market.
Well, this week is going to be key because we basically have the bulk of the earnings that people are going to care about. We're going to hear from Apple, Google, Tesla, and a lot of others. This is the week that I think will show us whether we can break through or not. If these earnings come out and they're taken well, I think we can break higher through those ranges and actually maybe add in another couple percent or two. However, if these numbers don't come out well, if Apple disappoints, if Google disappoints, then all of a sudden I think you can look at that upper trend line and say that's probably all we're going to get. This week is a big deal in the fact that we've got major corporate earnings coming out. We also have some news on the schedule. We have GDP coming out, advanced GDP. This one is not really going to matter, but I just want to point out the number, 2.5%. That is what fourth quarter growth is projected as. Third quarter growth was 3.2%. this is still a fairly fast-growing economy, a little bit over what we've done over the last decade of an average of 2%. This is a little bit hotter than the Fed wants, and so the Fed isn't going to like to see a hot number. Even though it is in the rearview mirror, I don't think people are going to really react to it. The other big news this week is the core PCE price index. This is the Fed's best inflation measure, the one they watch the most. It's supposed to come in at 0.3. Now remember, they want a 2% annualized inflation rate. This is about 3.5%. So this is still hot. If this core comes out at 0.4, all of the gains that we've seen are likely about to evaporate. This is a big number. So Friday, I think this is the number you want to watch as far as economic news goes. Let's break down where we are in this market. We have been at a +1, +1.5 for the last couple weeks. We can't get any more bullish than that until we break through that upper trend line. However, you can't really be bearish here. So this is where you're in a market. It is not great for taking outsized bets for longs or for shorts. Most of your trades should be shorter term in nature and asking your positions to do a lot less. Lots of butterflies, lots of diagonal spreads, lots of theta positive stuff until we get a clear direction of where we're going to go. That's just where we are. Remember, at Maverick, we say trade the market in front of you, not the market you want it to be, not the market you think it should be, just the one that is in front of you. And take a look at this market. It is literally just in this range. That's where we are. So until something changes, you can't trade a different market than a sideways market at this point with a slight upward bias. Let's take a look at the sectors because we get a lot more viewpoints in the sectors.
Yeah, the sectors were pretty interesting this week. I mean, you can see we had 7 of 10 sectors down. And utilities was down, industrials was down, financials down. Those were the 3 worst performing ones. The other ones, between 0.5% and 1% and a little bit. Okay, communication services, even though that was an up week, it was only up 1.5%. And so there's a lot of choppiness in this market. And I'm looking at the sectors, and this is one of the things I think the sectors are telling a clearer story about where we're going to go than the broad market is. Because you take a look at it, you're talking big names in tech and big names communication services that accounted for a 2/3 gain in the NASDAQ, and that's the only place that did have the gain this week. So individually here, starting with utilities, I had to go to a -1 on utilities. I mean, just had had a really ugly day. It tried to recover some. We've broken below that support right there. So I think for whatever reason, utilities is going to be in a slow grind downward. Communication services was looking good last week. Still looks good right now. You see that candle on Friday, had a nice, put in a bottom on Thursday, really, really nicely. We're above resistance right there. I'm at a +2 on there. Give me a couple more weeks to deal with those moving averages, the slopes of the moving averages, and I'm happy to go to +3. Looking at real estate, I was at a +1 last week, and I'm at a +1 this week as well. It's just kind of hanging out there. This is going to be one. It's going to take a little bit of time to get past that 40 level. And that's just, we're in this ascending triangle right here. The more pressure gets put on that 40 level, the more likely it is we break through. I just think it's going to be a bit of a slog until we can do that. And then if the market turns more bullish, I think real estate has a better chance of breaking through. Until then, I think we just kind of grind up against it. Now, industrials, definitely a change. Okay, last week industrials looked really good at a +2. Technically, though, we've had a lot of damage done in 3 days. We tried to regain some of it on Friday. We couldn't do it. So this is one of those sectors that went from a +2 to a -1 in a single week. And everything is just so tight right here. There's no good place. I mean, you got the 20 overlaid on the 50. I mean, they're essentially, the moving averages are right there. You break through one, you break through both. And when you're doing a trend following system like we do, you're trying to be objective about how to score these markets, you've got to take a good look at that. Now, caveat here, we are at resistance at about that 98 level. I'm supported about that 98 level right there. So it looks like it bounced. We might be a slow grind back up above that 50-period moving rate average, fine. I'm more than happy to reevaluate next week. But until it does that, I got to say, -1 on industrials, which is surprising because that's one of the strongest sectors. Healthcare, we were to 0 last week. We're at a -1 this week. We broke through that support right there at about the 134 level, and it's just kind of slowly trending down. It's not in an elevator going with the cable cut or anything like that. It's just the slow moving escalator that seems to be in a shallow decline right now. So that was from a 0 to a -1. Looking at financials, we were at a +2 before. I'm at a +1 on financials. We bounced right off that 50. And again, this is another one. You get the 20 and the 50 so close to each other. You smash through one, you smash through both. But this one's looking a little bit better than industrials is. Mildly bullish at +1 on financials. Consumer was at a 0 last week. I'm at a 0 this week. Just a lot of chop. You can make me the case that, well, we closed significantly away from the 50-period moving average, so this should be a +1. Go right ahead. That's fine with me. As it is right now, I just see a lot of chop going on right here. And so, we might have a little bit of upside at that 140 level, and your downside to be about the 133, 134 level. So I think it goes more sideways than anything else as far as consumer goes. Tech, almost the same story. At a 0 again on technology. This one, a lot of chop, and it's one that's really having a tough time asserting itself which way to go. Materials, still looking good on materials. I think this might be one of those years where the story was energy in 2022. It might be materials in 2023. I think that's a distinct possibility with this long-term, several-month ascending triangle right here. We did take a little bit of a hit Wednesday, Thursday, bounced off that 50-period moving average right there, and we remade some gains, up 2% on a day on Friday. So this one's looking pretty good. I'm comfortable with a +2 right here. And finally, energy, slightly bullish at a +1. I can't give it any more. That's just as good of a year as it had last year. I think it's taking a break this year, and it's going to just continue to grind up. So looking at everything, when we started the year, everything looked like it was at the starting gate in a horse race. Well, it's really starting to differentiate itself right now. -1, healthcare, industrials, and utilities. Standing still, technology and consumer. Slightly bullish, financials, energy, and real estate. And materials and communication services are the two best looking sectors out there. I think that's where the money's going and will continue to go for at least the next several weeks. So let's take a look at a couple of picks here. So last week we were sideways to long DLR, and it pretty much turned in the way we thought it was going to. That was up 0.7%. So when you're looking at something sideways to long, you can't really expect a whole lot out of them. You see this just in a grind. So depending on where you are, we're still bounded, I'd say, between 100 and 110. I'm not going to ask for DLR to do a whole lot more with this. What we're looking at this week is Weyerhaeuser, and we are sideways to slightly bullish right here. And Weyerhaeuser is a large company. It moves very, very slowly. You can see we've got support down at the 30 level, 33 being the midpoint right there. And then again, 36 is just a good place to get put on it. So that's what it's looking at right there. Go out to February, 33, 30, 33, 36, I think is where you want to go. If you don't want to be, if you think that's too aggressive right there, you do 29, 32, 35. You're basically going to have very, very similar risk graphs. Just how much do you think it's going to float up? But I like Weyerhaeuser for this trade. And communication services. Last week we were long AT&T. Last week we were long AT&T, and it largely just went sideways for us right there. So depending if you still got some time left on your trade, it still is good. We're still in a nice high base. It just didn't do exactly what we were looking for last week. But compared to the the rest of the market action, to be stuck in there between 19 and 1950, I think that there's still some strength in here if you've got a little more time. This week, we're looking at Comcast. CMCSA, nice bull pullback. You can see Wednesday, Thursday, Friday pulled back to support right there at 38, and then closed up 3% on Friday. I mean, this is a really strong, very classic bull pullback right here. So the best way to play this, I think, is going to be a diagonal call. And we're not expecting a whole lot out here. You're going to go long those February 38s and short next Friday's 40s against it. Your risk graph is going to look really good. If it closes at 40 right there, you're at a max gain. If it just keeps going sideways, you still have a gain, just not as much. The only thing we don't want it to do is go down. Anything else is looking pretty good. And this has definitely got some strength to it. So I think sideways to up is the way to play this. And in healthcare, last week we were sideways on Eli Lilly, and this is one that it was looking good, looking decently up until Friday. And Friday the wheels just kind of came off. It didn't participate really in any of the rally that happened on Friday. So this one, we sized it for max loss. Just let this one go. And if you've still got a position on, you can see if it rebounds up into that 350 area. Again, if it does, you're probably going to start to see profitability there. But if you don't, just write it off and be done. Now we're looking at United Healthcare right here. Nice bear rally. And this is one where we want to wait for confirmation. Where is this thing going to turn over? All right, so it's been in a downtrend, got all the way down to about 475, broke through support at 490 beforehand. So where do we go from here? Good market action on Thursday and Friday, but this is definitely weak. So we definitely want to wait for confirmation. And when you do get that confirmation, lower low, lower high, I think you go out February 3rd and do that 480, 490 bear call spread. A nice $10 spread right there. Depending on if it does, roll over at about the 490 level on a spread like that, you probably could pull $7.50, $8 credit on something like that, but it is delta dependent. Very little theta going to be in that trade.
Industrials was my second favorite sector last week, and it actually performed fairly terribly as far as the relative strength it was showing. So last week we had a diagonal call spread on Otis Elevators. We had the 80-85. So we wanted this thing to close up at 85, and it did not. It actually dropped, and it dropped about 2.5%. We did get a nice little bounce here. So as far as technicals go, there's nothing wrong with this trade technically. It hit up against a point. It had a pullback. The whole sector had a pullback. The big question is, does it have another leg higher? And I think that's really going to depend on whether the industrial sector can get back into good graces. But as far as right now, again, we opened up a diagonal call spread. This is just a small loser. So 85 was our max point. We're somewhere down in here at 80. But we do need to see this thing bounce back up before this to be a good trade. This week, let's talk about Southwest Airlines. Now, you've likely heard the drama behind Southwest Airlines. And, they've had some issues, but ultimately their stock has been range-bound. Take a look at the moving averages just flipping on top of each other. So whenever you do a butterfly, you're basically saying, where's it going to close? I'm looking at a butterfly for the monthly options expiration in February. So this is about 4 weeks out. And I think it's going to be a little bit bearish. So I'm going to play this a little bearish. So I've got 35 as the middle of my butterfly. So I'm going to do the 30, 35, 40. And that's just going to give me a risk graph. It's going to look like this. 30, 35, 40. As long as it's inside of that little range, then there's going to be a nice little profit. If it goes out above or below, then that's going to be a loss. And then, of course, our losses are fixed on all butterflies. Next up in financials, last week we had State Street, STT. And you can see it had a pullback, but take a look at that move on Friday. That's exactly what we like to see. And we also had a diagonal call spread on this. We had the 80-85, and I love when this happens. I absolutely love. The 85 call expired on Friday, and it expired worthless. So we kept all the premium we brought in, plus our $80 call is now deep in the money and actually profitable. I love when this happens because I didn't have to do anything. The short call expires, and now I've got a long call next week. This thing looks like it's breaking out and going to run. It gives me a lot of options. I can just hold the long call and sell it at a target, or I could turn this into a vertical spread and sell the February 85 and bring in some more credit. Basically, I have a lot of options I can do, but it's all while the stock is breaking out to the upside. So I love having these diagonals in this position. So this one looks really good. This week, we're looking at KKR. KKR is just a big financial conglomerate. So I'm looking to play this one slightly bullish. I'm saying it's not going to go anywhere great. It's going to drift higher. I'm just going to do a little targeted butterfly. I'm going to reach up there at that 55. That's going to be my midpoint. And say, hey, I think this is where it ends up in about 4 weeks. I don't think it's going to break out and run because I don't think the market has that much juice in it. But it's showing some relative strength, and I don't think it's going to break down below its moving averages significantly. I just want this one to float up over time. This is not a fast mover. You can see this thing will move $2 to $3 over a week or two of time. I just need this thing to move up 2 points into that range, and we could look at some profits then.
So in consumer, last week we were short Kellogg right there. And you can see, sideways to short, this is down 3.5%. I mean, this is looking pretty good for us right here. We didn't, so if your trade expired, you probably had a decent sized profit. And this is actually one that would be, if this comes across your screener this next week, we just broke through support at 69. So, I mean, this is one that you could get back into as well. There's nothing wrong with it. This happens when you use a screener. If the stock comes up multiple times, there might be multiple trades you can make on that stock, maybe different strategies or something like that. But for a move like this that came down, this is the one that's actually not bad for another entry. This week we're looking at Archer Daniels Midland ADM, nice little bear rally right there, and now we're back down to support. So the best way to play this, go out to the monthlies. I think an 80-85 bear call spread right there is about the best way to play it. This is weak. If you want to wait for it to break through that 84 level, go right ahead. I think the weakness is definitely there. But I would love to play this because you've got that support way back in October, that $80 support from way back in October. So I think that's a decent floor for now. And technology. Last week we were short CrowdStrike, and tech did decently this week. So this was we're sitting at probably a small loss in this one right here. I think we had the 90-100. Yeah, we're probably at a loss for this one right now. So that's okay. We'll just move on. What we're looking for is Taiwan Semiconductor. Symbol for that is TSM. Nice high base. Broke out about 2 weeks ago, and established broke through that resistance right there. And we've just kept running. So this is pretty good. So this is something I want to give some time to. This isn't something I want to ask a whole lot of just from the way the market is. But I'm looking at that diagonal call spread, go long February's 85s and short this next week's 92s, asking for, to make, $1 in a week. Okay. We're going to get a pretty good premium out of those 92s. And if it closes somewhere around there, I'm going to be completely happy. This is looking pretty good for us.
Materials was my favorite sector of last week, and it was down a little bit, but take a look at AEM. We've got a 55-60 bull call spread on this all the way out to February, and this is just a beautiful, beautiful chart pattern. This one is absolutely ready to trade. If anyone's saying, hey, I'm not in this one, should I get in it? This one is absolutely great. It looks fantastic here. We closed at the high of the candle. We broke out of that resistance of 56. This one to me looks like it wants to run along with pretty much all of the gold sector. So this one looks really good. This week, we're looking at something in the chemical sector. This is Aventor. All right, so this one has had a really nasty fall. And we consolidated here and we broke out. And here we are starting to get a little bit of momentum going. That being said, I want to be fairly realistic about where this one is going to go. This has a lot of ground that it can make up. But I'm looking up to this 25 area. I'm going to say, okay, you know what? Give me 4 weeks. I'll put on a 22.50, 25 bull call spread. Give me 4 weeks to get up to that 25. Look, if the market turns over and dies, or if materials turns over, then yeah, this isn't going to make it. But if we get a generally positive backdrop, I don't see any reason why 25 can't be had. So vertical spread on this. I don't want to be long calls here. I don't think there's enough upside for it, but a vertical spread makes a lot of sense. And I agree with Darren with the energy sector. I think we had a great gain last year, and I think it's tired. I just think it's tired. Last week, we put on a 110 butterfly. So a slightly bullish butterfly saying, okay, we think it's going to drift up into this area. And that's exactly what it's doing. We had the 100, 110, 120. We want this one to keep drifting up, not make a huge run. I think this trade looks absolutely fantastic at this moment. When we get to the 110, I'm going to take half the profits off the butterfly and hold the rest. This week, we're going to be looking at Cheniere Energy. Now, this is looking to be more bearish. You can see the moving averages are all coming down. We had a little bounce off that bottom, and it's kind of failing here. Not that it really matters, but natural gas is back down to $3, if you can believe that. When natural gas was at $3, Cheniere was at about $80, and here we are at $150. It doesn't mean that it has to go down, but you can see the chart pattern is showing, hey, we've got negative momentum here. We had this big bear rally off 135. We hit up against this point. I'm looking just to put on a basic bear call spread here, and I'm looking at the 148 to 153. As you can see, I'm not asking this to do a ton. This is what I'm playing here, and I want it to be below this 148. That is not asking for a lot out of this, and I'm just asking for 2 weeks. Ultimately, I think this thing could go down to 140, but the market is not bearish enough for me to be that aggressive, so I'm going to just do something fairly mellow here. Well, that is all the trades we have. If you have trades you want to share, Mavericks, go jump on the website, go into the members area, go into the forum, and we love the discussions that everyone has in the forums. Let's go ahead and wrap this up. We've got the markets. We're still at these major resistance levels. We cannot get super bullish or even moderately bullish until we push through these. And if Darren's right and we don't push through them, then we're going to just have to stay in this no man's land where it's not a bull market, it's not a bear market, it's just a market that's going nowhere and choppy. If you don't know how to trade these markets, they can chew you up. Lots of non-directional stuff. That's what we love at Maverick for options trading, is that when markets do this, we just do targeted butterflies, which you saw. We've done a lot of targeted butterflies lately, a lot of diagonal call to diagonal put spreads, and very few aggressive targets. Everything very close to where the market is right now. If we do break out, which I think we will, I don't want anyone to get super excited and say, oh, we're back to 2021. Guess what? We are at a totally different place in the economic cycle than we were in 2021. In 2021, people were getting more money. Inflation was going higher. Prices were going higher. Everything was going higher. Everything was great. Now everything's like compressing. People are tightening down and inflation is causing issues. Like, we're just at a totally different part of the cycle of the economy. If we do break out, I don't want to see anyone trying to chase aggressive longs here. We can open it up a little bit, but just not all that much. If you're bearish, guess what? Be short-term bullish just for the moment. Remember, trade the market in front of you. At some point, yeah, it'll go back to being bearish. But for right here, right now, if you're trying to aggressively sell this market, you're in the wrong spot. So just short term, just join us at the sideways to slightly bullish camp. When it turns over, we'll all high five each other and go short and have a great time riding it down like we did in 2022. But until then, I think you've got to lean a little bit bullish. That's about it. Well, that wraps up our trading room. Thank you so much for joining us. Have a great weekend. Goodbye, everybody.
Good trade, everyone.